working. But for me, I didn't even think about quitting because I was just so interested. I was so interested about, like, I remember like every single day I would go on YouTube and just try to find videos, try to educate myself, try to just do anything every single day. Not because I felt like it was a job, not because I felt like it was work. For me, it was interesting. For me, I was learning. For me, even to this day, like I said, I'm still trying to learn.
Do you feel like there's a lot of traders out there where, I think we talked about it earlier, to be fair, in terms of that misconception that one day they won't have to put in as much work? Because I realize as well that a lot of people might think that when you reach a level of success, the work can slow down a lot. You know, you reach this amount of net worth or P&L, the work can slow down a lot. I can get a bit more relaxed, you know? So like, for example, you mentioned about your routine. Yes, you may enjoy certain things, but when it comes to your trading, do you still stick to your routine? When it comes to being on the market at a certain time, checking certain stocks or fundamentals that you need to check, recapping what's happened, et cetera, et cetera. Like, what does that look like for you as well?
Yeah, definitely. So let me kind of walk you through my morning routine, right? And just to kind of clarify on what you're saying is, if you don't continue to grow, you'll be left behind.
Yeah.
So the question is, all right, you're a 7-figure trader now, but if you get lazy, are you okay being only a 6-figure trader?
Yeah.
If you're a 6-figure trader and you get lazy, are you okay being a 5-figure trader? And these are extraordinarily like large amounts of money that we're talking about, right? So like, take that with a grain of salt. But like, for a trader level, if you go from a guy making $1 million to making only 500,000, that's not good. If you go from 500,000 to 100,000, that's not good. But it all depends on like how much work you're willing to put in. So let me talk about my routine. So I usually wake up these days around like 5 a.m.
You said that so casually.
Yeah, because I used to wake up at 4 a.m. So I got a little bit lazy. My first, I would say, 5 years of trading, I was probably up at 4 a.m.
Why?
I just want to have more time to prepare.
Where did you?
New Jersey. So I'm on the Eastern time zone. So I'm on market time. So back then I would wake up at 4 a.m. because I wanted more time to prepare. Now I'm lazy. I wake up at 5 a.m. Wake up at 5 a.m. And I'm going to explain everything in detail so that there's nothing left out. Is first thing I do is I always check my phone. Are the markets gapping up or gapping down? Is there any overnight news? Based on that, I'll have like a little bit of an idea of what's going on. Next thing is I have to have coffee. I cannot function without coffee. I'm like a zombie without coffee. So get my coffee and go to my desk. By that time, it's what, like 5:10, 5:15 in the morning. So I look up, now that I looked up which indexes are gapping up or gapping down, now I look at individual stocks. What's the highest percentage gainers of the day in the small cap world? Based on that, I kind of narrow it down to the top 10 high percentage gainers. Then I'll look at the news. What is this running on? Is it up on like an FDA news? Is it up on, merger? Is it up on they cured cancer? Is it no news? Or is it a news that they released 2-3 weeks ago? So that narrows it down to maybe like 5 or 6 different stocks. Then what I do is I look at the daily chart. I look to see what is the pattern on the daily chart. What I've found that I make the most money on is the stocks that wick up and wick down the same day. So these are stocks that go up and go down the same day. History tends to repeat itself. So I look for stocks that gap up, gap down, or an overall downtrending stock. If I'm seeing a stock that's maybe doing like a multi-month breakout or whatever, disqualified. So I'm looking for stocks that have downtrends on the daily chart and looking for stocks that tend to give back their gains on day one. And you can see that very clearly by high wick up and wick down on the daily chart. So of those 6 stocks, narrows it down to maybe like 3 or 4. After the 3 or 4, then what I do is I look at the filings. Are they highly dilutive stocks? Are they low float stocks? Do they need money? Do they need cash? Whatever. That narrows it down to maybe 1 or 2. Then what I do is I look at the pre-market chart. What is the pre-market chart doing? Is it a stock that's continuing to make higher lows pre-market, or is it a stock that topped out and is starting to slowly make its way down? I look for the stocks that slowly make its way down. That narrows it down to maybe, let's say, 1 or 2, depending on what the setup is. And then I'll draw my support lines, I'll draw my resistance lines, and then wait for the market to open. And then when the market opens, if it hits the resistance line, I short it. If it breaks down, I add to the winner. And depending on what type of setup is, I'll go in heavier or I'll not go heavier. And then by 10:30 a.m., I cut off my trading, walk away, and that's it.
Oh, yeah, I love it. Step by step. In terms of the filings, for example, what sort of process in terms of length of time do you think that takes for you?
So back in the day, there were not many resources for filing. So I had to go individually throughout each of the filings, look at the 10K, the 10Q, the 424, all these different things. But now there's a company called Dilution Tracker, where you sign up and like it does all the work for you.
Really?
So the problem is now that everyone has that edge. So that's the problem, right?
More people.
What's the barrier to entry? Like $100, right? Let's say whatever it is. Like, so now my edge of understanding company filings is now readily available, which makes it a lot more crowded of a trade. So you can't just rely on the filings and the fundamentals of the stock. That's why I'm looking at the news, the daily chart, the pre-market chart, the everything. I'm trying to paint a picture of the stock. I'm trying to see what is this company. Is it a stock that ran up 2 weeks ago on the same news? Is it a stock that's low on cash? Do we know that they need money desperately? They're gonna do dilution, raise money. The stock price is gonna go down. So I'm very process oriented, and some days I go through that entire process and nothing is there.
Fair enough. Yeah.
Right. So sometimes there's 5 stocks that fit that entire process. Right. It depends. It really depends on the day. But I can now show up to the market and every day have a repeatable routine that I could follow and make money out of.
What would you do in those scenarios when you have multiple that tick every box?
Yeah, so at that point, I would try even more to narrow it down to like 1 or 2 that I see fit. And what I like to do is I set something called fantasy orders. So like limit orders at certain resistance points. It's like fishing. You cast your line and wait for the fish to hit.
Yeah.
So at that point, if there's multiple stocks moving, I am not really good at multitasking. So I can't focus on 5 different things at the same time. So I'll set some small starter orders at different resistance areas. And if they hit, I'll be involved in the stock because it'll be at my targeted area, and then I'll start to focus on that.
That's great. That's great. Do you ever do like market execution as well? Or is it primarily limit orders?
I primarily use limit orders. Yeah. Primarily.
That's what I would prefer as well. That's what I
yeah, because market orders, you don't know if you're going to hit a bad fill. You don't know what's going to happen. There's a little bit of delay. I think
it's more emotional as well.
Yeah, I'd rather wait for the stock to come to me, right? It's same thing. You have a plan. So it's actually something that's very important. When I was at S&B Capital, I was coached by Dr. Brett Steenbarger, who is incredible. And I know you're going to have him on soon, right? So that's going to be really amazing. But
thanks to you, by the way.
I'm very happy. He's incredible. Shout out Dr. Steenbarger. You're awesome. So we were going through a bunch of stuff, trying to improve my trading and trying to help, because when you have a resource like Dr. Steenbarger and S&B Capital is giving you access to him for free, knowing that he charges thousands and thousands of dollars to other hedge funds or whatever, you got to use it. So one of the big things that was really hurting me is actually 2 things. So I would always get FOMO, and I would always get into stocks early. And, I talked to him about it, and my biggest problem was that I would hate missed opportunity. And what he taught me is, rather than being focused on missed opportunity, think about the missed consistency that you have. So if you're missing your consistency by being overly emotional, by missing that opportunity and getting FOMO, your next couple of trades end up getting screwed up. So rather than worrying about, like over trading, FOMO trading, worry about, if you do that, it's going to hurt your future trades. And that's kind of what helped me there. Now, another thing that he talked about is using your body's tells to help you understand if you're in the right trade or not. And let me explain. So do you ever get that feeling where your heart is racing, your head is pounding, you're kind of shaking, you're like a little bit emotional? That is your body's natural reaction telling you that you're not in the right trade. So what that means is this: if you have planned your entry, your exit, your target, and your stop, you have no reason to ever be worried ever. If your body is giving you that feeling, that means that one of those 4 things has not been planned for. If all of those things are planned, you have nothing to worry about. So whenever I'm in a trade and I feel like anxiety, I feel my heart racing, my head sweating, I'm kind of shaking, I know that one of those 4 factors has not been planned for. And that's what he told me. So entry, exit, stop, and target. So long as you have all that, you have nothing to worry about. And if your body is telling you otherwise, you have not planned for that accordingly.
S&B Capital is a topic we nearly didn't touch on. I nearly forgot. I don't know how that's possible, but I'm glad you brought it up. What was that like for you? Like, where were you in your trading career? Because not normally, but from what I know, a lot of people go through like a graduate style scheme where they will go through and do, I think, 1 or 2 years as sort of a junior trader, learning the ropes, learning from the seniors, being in the environment, developing strategies or being given strategies, and then go through that process until they're a senior trader, managing capital, getting profit split, etc. I think, if I'm not mistaken, was it slightly different for you?
Definitely.
Yeah.
So at S&P Capital, they like to train their traders from the ground up.
Yeah.
Because by training your traders from the ground up, they don't have the bad habits that most other traders do.
Yeah.
Because they learn from the beginning what not to do.
Mm-hmm.
The hardest thing in trading is unlearning your bad habits, right? So they would rather create traders from scratch to avoid all that. And they do an incredible job at that, right? So for me, it was a little bit different. So I was actually on the Chat with Traders podcast. And when I was on there, I actually got a call from the host, and he said that Mike Bellafiore wanted to, have a chat with me. And at the time, I didn't really know who he was. So we had a small talk. He's like, hey, like, would you be interested in, giving a speech to our traders? We like what you talked about on the podcast. Like, we'd love to see, like, if you could help our traders out or whatever. I was very naive at the time, right? I didn't know who I was talking to. I was like, if you get me a steak dinner, I'll be down. He's like, okay, sure, whatever you want. Like, at that point, I'm like, what, right? I'm so naive, right? I don't even know. I don't know how important this guy really is, right? So going to give a speech to the traders there. The video went super, super viral. I think it got like 7 million views, something crazy. And after that, I got a call from him the day after from him and his partner, and they mentioned that they loved what I talked about. They see some potential in me, and would I be interested at trading on their desk? So I was the first trader that was not trained by them to enter the desk. And I was very, very blessed that they sat me next to their highest earning trader. He was, even to this day, he's the best trader that I've ever known, ever seen, ever. And again, back at the time, I was very naive. I didn't understand what that was like, right? Because I'm seeing him make $100,000, $200,000, $300,000 a day, right? And at S&P Capital, the way they do it is you could see what positions other traders are entering. So I could see on my screen that he was entering short XYZs, and he was 90% short bias as well.
Really?
He was 90% short bias, but he was incredible. Like, I'm telling you, that what he did better than any other trader that I've ever seen is when he was wrong, he would not think about it. He would market order himself out of it. There's no, I'm waiting to see what happens. I'm waiting to see this. If he was wrong, like this, he would get out. And that was some of the best risk management I've ever seen ever. Wow. And that's why he's able to do the numbers that he was doing, right? So the biggest thing that I regret not doing there is putting myself out there more. My biggest problem was that I was so kind of shy that I didn't try to network as much. I didn't try to learn as much. The environment was very friendly. Everyone was really nice. Everyone was so helpful, but I was just really, I went from trading alone in my home to being in a room full of other traders.
Was that the jump from?
Yeah, I was at home, right? I was at home trading, and then all of a sudden I'm in a room filled with like 50 of some of the best traders out there, right? So I was very nervous. I was very naive. I should have been a lot more willing to put myself out there. So that's something that I struggled with. But overall, it was an incredible experience. Even just being able to see the numbers that these traders were putting up, to see the discipline. Like the trader next to me that was making all that money, he would do a daily report card every single day. Even to this day, I'm sure he's still doing it. A daily report card every single day. Dr. Steenbarger, he would see 2-3 times a week. He was putting in the work, and he's so much so that he deserves it, right? He deserves it. But for me, being in that environment, I learned what it was like to be like a real professional trader, right? They have morning meetings before the market opens, right? The senior traders coach the junior traders. So it's a very great environment. The problem is that it's very difficult as an outsider to join in, because I understand they want to create their own traders. It makes the most sense. And the traders they do create is really, really incredible. But shout out to them. They are an incredible, incredible operation there. They're the best out there. They're definitely the best out there.
Do you think it was beneficial as well, just to be able to see other traders and how they're performing? Because obviously at that point you're already profitable anyway. So I was, the usual question is like, did that help you in your journey? Because you got to see other traders and how they're performing, and you knew it was possible then. But by that point you already knew it was possible anyway.
I knew it was possible, but the numbers that they were doing is just crazy.
Do you think that opened your eyes into what was truly possible?
And back then it was pre-pandemic. So I'm sure the numbers that they did after that was just stupid. I've heard stories, people making $3, $4, $5 million on a day on GameStop. Wow. I've heard people making $10 million in a day, and these are the same stocks that I trade, right? So it really opens up your eyes to the opportunities and the possibilities out there. But the reality is that it's competitive. You see everyone's P&L every single day. There's a leaderboard. So let's say I make $50,000 in a day. this motherfucker made $250,000 in a day. So it kind of pisses you off, but also motivates you. But it also gives a competitive edge of, I want to be number one on the leaderboard that day, right? And, you know, I think that maybe I was number 2 one time, but there's people that make like millions a day.
Yeah.
You know?
It's incredible. Absolutely incredible. And like you said, they're doing great work over there. Hopefully we'll go see them soon. In terms of your sort of biggest advice to traders out there, like you see the space, you're active on social media, so you see kind of what's going on out there. Probably not in some of the darker elements of the industry, but generally, what are your thoughts? You know, what do you think most people are struggling with? What is it that you can really say, like, if people just stopped doing that and really just changed up, they would be more profitable, they would make progress?
Yeah, it's a couple things. Number one is losing money. As simple as that sounds, is traders tend to lose more money than they should. So the number one thing that I would do is set a max loss auto liquidation at your broker level. So what that means is if you hit this number, your broker automatically liquidates you, right? It takes the hands off the button for you and the machine automates it. So the problem is that let's say you make $100 a day. I think you should set your max loss auto liquidation to no more than 2 days worth of trading. So if you make $100 a day, if you're at minus 200, system liquidates you and kicks you out. The problem I see is that people make $100 a day and they lose 2,000. They lose 20 days worth of work. They lose freaking 3 weeks of trading after one losing day. So if you're able to limit your losses, that's number one. Number two is make sure that you're actually learning a strategy that works. A lot of people, they get involved in YouTube, social media, and they're learning strategies that are outdated. They're learning strategies that don't freaking work. And also make sure that the person you are learning from is not only him making money, but the students are making money as well. So I can make money, knock on wood, but it doesn't mean anything if I can't teach anyone that skill. So never judge someone based on their own profits, because number one, in this industry, there's a lot of frauds out there. Make sure there's the broker statements, make sure there's the confirmation, which I love that you're doing now at the podcast, is everyone is broker verified, legitimate people. So that's awesome.
People thingy, yeah. That was an interesting.
That's the way to do it. That's the way to do it.
100% is. I think what was interesting about that was I was vocal before that. I didn't start every podcast saying this is not a verified trader.
Yeah.
It was giving me. I never asked anyone, simply because on my come up, it was a case where it was like, who was I? You know what I mean? Like, who was I to ask people?
Sure.
I had like 10K subs or whatever. But then we grew so fast, and it got to a point where it was like, I need to do something, but I should. My worry was, and it was thanks to, one, doing interviews with like you and Luis Borsellino. That New York trip a few months back really opened my eyes, alongside Jack Schwager as well. Because it was like, when I was speaking to Jack, I mentioned these things to him, because I asked him, like, how did you get all these people to give you, proof essentially for your books? And he was like, obviously the first one was people he knew. But after that, that book became so famous, people were just sending it to him. And then that's why like Unknown Market was full of people who weren't essentially famous. So it opened my eyes to thinking like, I can do that. And another reason was I thought that as a retail podcast, like, why would any professional sit with me or anyone who's performing at such a high level? So I always just kind of capped myself into this bubble of like, I can only do retail traders and influencers and just do my best to pick the right ones. I always tried to like do verification through like these prop firms, payouts, or from people who live trade. But it's not good enough, if we're at a level now where we want to increase the quality, then we have to do verifications.
I'm excited for you, because now it's going to bring a whole new level of traders as well, which I'm interested to learn about too.
That's the fun bit. Yeah, that's the fun bit. But as you were saying though, in terms of
so
verified traders,
max loss, auto liquidation, learn from someone that can prove that their methods are repeatable to other people and not just himself. Because there's people that are amazing traders, but not great teachers, right? And if anyone says that trading is easy, you're going to make money overnight, run the other way. I'm telling you, trading is hard. It's going to take time. It may take a year. It may take 2 years. I've seen people make it faster. But the thing is, if you're not willing to dedicate at least a year, maybe even 2 years of taking it seriously, then don't even try. Don't even try. Right?
I love that. To finish up on, it was like the topic we started with. And I think it's the perfect question to ask you as well, as someone who's done it. But equally, I think we're going to see changes moving forward. Obviously, with Trump coming in, the markets will probably have some sort of shift many times, probably in the 4-year period. if you last the 4 years, hopefully. Fingers crossed. But yeah, so like changing strategy or changing like edge changes. What does that look like? Is it the whole entire edge that's changing? Is it just slight adjustments? Like, what are you looking for? How do you make those sort of changes? Any sort of insights that people can just have in mind in case they need to do the same?
Yeah. I think something to understand is the market moves in cycles. There are certain cycles where, stocks are overly bullish. There are certain cycles where stocks are overly bearish. There are certain cycles where stocks pop and drop. There are certain cycles where they end up grinding back. The thing is to understand what type of cycle you're in. And the way to understand that is what is going on that current week in the market, right? So, for example, right now, as we're recording this, the entire market is going straight up, straight up, straight up based on Trump, right? Chances are it's not going to last forever. There has to be a profit-taking day. There has to be consolidation. There has to be everything. So to be in tune with the markets, you'll be able to see when the cycle is adjusting, but also to not be too early on that adjustment, not to say, all right, the profit-taking has to happen. I'm going to do it today. Wait for the confirmation and then join the trend, right? They always say the trend is your friend, right? It's so simple, so simple. But if you anticipate, it's not the way to do it. Wait for the confirmation, wait for the signal, wait for something to tell you, like PHUN, the signal was the CEO quitting. That was the catalyst. I don't know what the catalyst is going to be for a certain profit-taking day. It might be the Fed, it might be whatever, but wait for some sort of signal to tell you that the cycle is changing rather than just your bias.
Yeah. Do you think that's where a lot of people go wrong? Is they're constantly trying to predict?
And they say that it worked last month. Why isn't it working this month? Let me
That's
just keep
always
doing
the
it.
mistake, isn't it? Like when it works the one time. It's like, let's say you have a rule, don't trade Monday. But then you trade Monday that one time, it works.
Yeah.
And then suddenly you're trading every Monday after that.
Exactly.
And it's not working.
Exactly. So a lot of people are like, oh my God, but like I made $100,000 in January of 2020. Motherfucker, we're not in January 2020 anymore. We're in 2024. The shit is different. It's very different. So they keep that in their head. It's like a syndrome where you're like, but I made this much money in January doing this. I have to just keep doing this to make money. No, that's not how it works. You have to adjust and adapt because that is not working anymore.
I love that. Alex, again, I really appreciate us doing this again for the second time. We're definitely not going to do it a third to redo it.
We're going to do it after the $1 million day.
Yes, we will. We will. And hopefully we'll do a roundtable. I know we've talked about that. So I'm very much looking forward to that as well. The links for Alex will be in the description below. So make sure you check them out. And everyone, make sure you hit subscribe, hit like. There'll be other episodes on screen. We are only bringing you, as Alex said, verified traders moving forward. So this will be the spot for that. Hit subscribe, drop a comment of your biggest takeaway from this episode. I know there was so much to take away. And until next time, everyone, take care. Doesn't matter the industry. So I absolutely love hearing that.
Jem Carson.
Jem Carson.
Jem Carson, he's the founder of Kai Wealth,
who some people describe as the time traveler of trading.
The 13th of January, a tweet that you made, I believe at the 29th of November, if I'm not mistaken, when someone was asking in regards to the S&P gap being filled post-election. How did you make such a direct and correct prediction?
For many years now, we've been very accurate in prediction, but really since February last year, we pretty much called every single major move and vol environment over the course of, I would say, 10 months.
His ability to make precise market predictions astounds even hedge fund managers.
If you really look at why structural flows happen, and those flows are predictable, and they can help kind of delineate when certain types of things are more likely. Pair that with some macro, and it can help to delineate very precise outcomes. So if people think it's magic, there's a saying, I think any future technology that is sufficiently sophisticated appears to be magic. The reality is that there is a lot of more information out there than they realize that allow you to trade with more accuracy. What's the next January 13th call? I'm happy to lay out multiple, but they may seem to people as us saying up or down. Remember, we're not predicting up or down. We're predicting
number one podcast in the trading space, the fastest growing, and that's thanks to every single one of you. Welcome everyone back to the Words of Wisdom podcast. We are back once again and still the number one trading podcast in the world and the fastest growing thanks to all of you and our incredible guests. We're currently on our US podcast tour, the biggest tour in podcast history. I've not seen one like it. We are 10 states, over 20 podcasts, all with verified, profitable, and some of the very best traders in the world. And talking of which, today we're in Chicago. So we're actually 9 states into our podcast tour, but we thought this would be one of the very best, just to highlight the levels to come. So make sure you have your notepads ready. And this tour wouldn't be possible without our sponsor, TradeZella, who helped us make this happen. They're the best tool in the market for backtesting, journaling, in-depth analytics. So make sure you check them out, and a huge thank you to them. But today, we are here with a 26-year plus trading veteran. He is a quant. He is actually the co-founder of Kai Volatility and Kai Wealth. During the great financial crisis, he was one of the largest market makers with 13% of the options volume. Is that correct?
In the S&P 500, yep.
Yeah, okay. Well, it's the one and only you've already seen. Jem Carson. And well, I was actually meant to add, apparently a time traveler too, is what I'm hearing on Twitter. A lot of talk of the town recently. I know you probably had tons of requests, so I'm truly honored that we've been able to sit down today here in Chicago. I know it was last minute as well, so thank you very much for being here.
No, thanks for having me. Looking forward to a kind of an extended conversation where we can kind of get through everything today.
Definitely. I'm very much looking forward to it, and I know we're going to have a lot of education when it comes to the audience on so many different factors. And I just want to kick off with one question, and I know you've probably gotten this question a lot recently, but the 13th of January, a tweet that you made, I believe at the 29th of November, if I'm not mistaken, when someone was asking in regards to the S&P gap being filled post-election, how did you make such a direct and correct prediction 2 months out almost?
Yeah, I mean, it's always about probabilities, right? So when you get something right like that, which we've done, by the way, several times in the last 3-4 years publicly, almost to the day or to the day, people's minds kind of explode. But the reality is there are dramatically more probable paths in a distribution of outcomes than others. And if you really understand flows and particularly market structure as it relates to derivatives, which have time components in them, they really allow you to pinpoint what those higher, more likely paths are. And that was just a great example. Like I said, we've done similar things. If you go kind of look back the last several years, in early 22, we predicted the decline several months out, almost to the day as well. Again, we'll talk about it in this conversation, I'm sure, but if you really look at why structural flows happen, and a lot of those flows are which have time components and they can help they really allow you to pinpoint what those higher, more likely types of things are more likely. And that was just pair that with some macro and some bigger picture things, and it can help to delineate very precise outcomes. So people think it's magic. There's a saying, I think, any future technology that is sufficiently sophisticated appears to be magic. And I think the reality is markets are, and traders are tuning into the realities that there is a lot of more information out there than they realize that allow you to be more precise and trade with more accuracy.
What did the beginning of your trading journey look like in terms of where did that interest come from?
Oh, wow. There's several different interests. I think the derivatives interest really started in college. My mother and my father are both engineers. My dad's a PhD structural engineer, designs offshore oil platforms for companies. So, my mind works much like an engineer. Very quantitative, always thinking about things in multi-dimensions, trying to figure out how to fix and solve things all the time. But that paired with an upbringing where I was born in London, lived in Turkey as a child, grew up speaking multiple, different languages on the border of cultures, and then living in Texas, and then eventually going to boarding school on the East Coast of the U.S. while my parents were in Norway. So that kind of upbringing really gave me made me a third culture kid, which was, almost like a third party looking into my own world and culture around me. The people in Texas seemed different. I was a bit of a square peg in a round hole, but my parents, and the Turkish culture seemed, different. And I was a bit of a square peg in a round hole. And I think this happens to a lot of people who grow up on the border of different cultures. And I think that interest that develops from being a square peg round hole and culture and policy and social relations sociology really came together with that engineering and mathematical background in the form of capital markets in college. I think the thing that unlocked kind of my path, who I was into that world, was I got a full tuition scholarship to college, to university, and my freshman year, my parents gave me the money they had saved for my college education. Very fortunate in that respect. But it was 1995, and this is how variance and probability comes into outcomes. I was talking in that kind of mindset. 95. If you're a student of markets, markets made a hockey stick straight for 4 years up into the tech bubble, and I was fortunate to be managing some money that my parents had given me, and I was risk-seeking as a young man, and I was quantitative, and the people I talked to about trading in college had a similar mindset based on the school I was going to, which was a more engineering kind of Rice University, which is a more engineering kind of focused school. And so I just got into options at an early age, got into quantitative finance. So my path was very different. A lot of people come into trading or investing, which are two obviously different things, but related, from fundamentals or technical analysis. And I really came from a much more quantitative market structure perspective. That drew me to Chicago. That's where we are now. I've been here for now 26 years. And it led me to the trading floors of Chicago and the options pits. In 1997, there was an event called Long-Term Capital Management, which some people here I'll be aware of. That was a massive vol and options-centric event that was incredibly interesting to me. I knew people out here on the trading floors who had not only benefited and profited through that, but had followed it very closely. And that was kind of the final thing, the straw that broke the camel's back, that drove me to come out here and start experiencing that. But that's my origin story, I guess. That's how I got started. I really didn't know a thing about options. I thought I did, and probably like a lot of people that are listening today. There's a lot more behind and underneath their structure and how they affect markets. But I had a trial by fire in those options pits in Chicago, and eventually built my own market-making business, and grew that to one of the biggest in the option space, like you mentioned. So that's how it all started. That eventually merged with my deep interest in macro and policy, and so we'll, I'm sure, talk about some of those things.
Definitely. Well, so much has happened in such a short space of time there, and especially when you consider that you came in around 97, right?
I came to Chicago in 98.
98. Mm-hmm. So from 98, but then starting up your market maker business going into the great financial crisis in that short space of time, all things considered, that's a lot of progression to happen in such a short space of time, especially that introduction into options, as you say, with options at the time, thinking it was probably surface level, but then obviously over that time, so much more deeper that we're definitely going to get into. But coming in at the surface level, what were some of the trials that you had to go through in terms of learning those different dynamics?
Profitable trading really boils down to two things: opportunity and volatility. And that is why the podcast has partnered with Market Journal. Because between the years 2016 and 2020, the amount of opportunity that was available, as well as volatility to take advantage of, was at the highest it's ever been. And all of that really pointed towards one man, President Donald Trump. During his period in office, all it took was one tweet, and that would present so much volatility, and the right traders would take advantage of that and would create their record P&Ls. And that is why those same traders are so excited for this new period between 2025 to 2029, when we have President Donald Trump back in office. Now, Market Journal is going to give you the weekly insights you need across crypto, Forex, futures, and the stock market. So regardless of what happens, whether it's a tweet, a particular stock running up hundreds of percents, whatever volatility and opportunity that the Market Journal can identify, it is going to share with you every single week. So you can purely focus on taking advantage of those opportunities and taking advantage of that volatility to create your record P&L. Now, Market Journal is absolutely free. All you do is click the link in the description below, put in your email, and you will receive key updates on the markets every single week. So you are always up to date with what's going on and ready to execute when the time is right. Links in the description below. Thank you for enjoying this episode.
So, started in 98, and your experience definitely colors your perspective. And I think it was very fortunate for me to see the tech bubble kind of firsthand, both from a sentiment and societal perspective. I actually, before I came in 97, 98, worked for a tech startup in Houston. So I experienced, inside what that euphoria was like and what the flow of capital tied to kind of Greenspan's monetary policy was like. And then I got to come see the upside volatility, which was honestly in history, at least in the United States, the biggest kind of right tail event we've ever seen. And that really is important because very few people have that deep experience. I was able to see dramatic upside volatility, not just in financial markets, but in derivatives and how that plays out and affects market structure. And then, those were early days. And then in January of 2000, I was moved to a senior role running RBC's equity index derivatives desk. March 2000, the tech bubble burst. And so then getting to see that right tail event turn into a massive left tail event. The NASDAQ lost over 90% of its value. 95% of all tech companies went bankrupt during the tech bubble. These are numbers that if you weren't around during that time are almost unfathomable. It was an incredible experience and education in bubbles, how they form, how market structure affects them, and what they mean, right, to broader liquidity as well. So I have ever since that time had those things top of mind, right, and been gathering in the back of my mind data to help construct a better understanding of how liquidity changes cycles, how it drives outcomes. So had a lot of success in that bubble burst, whereas other people were facing liquidation, options markets were the world was coming to hedge and get out of risk. And so that was an incredible trial by fire and education for me. It also, at a young age, gave me an opportunity through kind of my success to leave the bank and start my own market making group in 2006. And so I backed our group in 2006, started a more boutique index-based trading operation that eventually grew to, like we mentioned, one of the biggest. Through that process and evolution, experienced not just the banking crisis firsthand, but also saw the evolution of options markets and their importance, their increasing importance to outcomes. It was important in 2000, but by the time we got to 2008, much more developed, much more important as a feedback loop to the outcome that we actually saw, and that also obviously informs the way I look at the world today. It really is what drove my deeper understanding that period, being one of the biggest dealers, if you will, or not just market makers, but entities holding inventory and warehousing risk in the marketplace. I knew what the positions of the world were because I held them. And when you know what those positions are, you begin to very clearly see how they're affecting outcomes. And see how they're driving market structure. So that really gave me a deep insight early on, before maybe a lot of others, into how options flows were dramatically important to the distribution of outcomes. And that realization really informed, once I sold my business, left, that market making space in 2010, it really drove a lot of my family office and personal and eventually fund investments that we now do in terms of developing models to help predict based on market structure and options involvement. Leaving that space, not that I've ever really left, but no longer being at the seat of a market maker, also allowed me to start investing more than trading. Again, people think they're the same thing often. Obviously, trading can be part of investing, but really did a lot of venture capital, private equity, real estate investing during that 2011 till kind of to recent. Over those periods as well, learned a lot about kind of the investing landscape. And the more I started doing that, the more it made me realize how oddly those two sides rarely mix appropriately, and how people think about investing really doesn't capture risk management nearly as much as it should. People think about investing as buying assets and buying them cheap and trying to hold on to them for long periods of times and capturing appreciation in assets. Whereas trading is much more trying to get good risk-adjusted returns and optimizing returns relative to the risk you're taking. And the way I started managing my family office was much more almost as a trader, thinking about long-term investments, but in the context of risk management. And I think, again, now integrating macro, my big picture, view and understanding from being a person who grew up all over the world and has a deep interest in those realities as well, and then combining risk management and trying to optimize risk-adjusted returns has really been, particularly adding in the flows of the market structure piece have been what finally led me here at 48 to kind of bring all that wisdom and knowledge together in a much kind of fuller, more kind of holistic way. Been quite the evolution through time, but really feel like we're hitting, I'm hitting my stride, and as a business and as investors and traders, we're really kind of at the best we've ever been at this point.
I love that. And there's, just to take it back ever so slightly in terms of the importance of options and option flows, why do you think that is, and how can you help in terms of the audience and even myself to a degree of understanding why options hold such an importance over, say, other markets?
Yeah, so let's start at the beginning. I guess people who start from a fundamental asset perspective think that assets have one value. It's a simple way to think, right? We should be able to value this asset. And even options are considered a derivative of that expected value of that company. And having not started from that perspective, but from a more derivatives, quantitative, distributional probability perspective, I'm here to tell you that an asset is much more complex than one value. Every asset has a rich distribution of outcomes and potential values, and that's what options price. They price every node in time, every probability of a certain value. They are three-dimensional representation of an asset, not a two-dimensional price. And by arbitrage, these options must equal that expected, the total probabilities, the total distribution must have an expected value that equals that asset value. And when you come to the market understanding that, you begin to understand that there's much more importance to options and other things like structured products and all the different assets who have much different dimensionality than just two dimensions, than just that stock or under what we call the underlying price. Nowadays, people think options are the tail wagging the dog. You'll hear that saying again and again, that they are starting to affect the underlying dog by, in all kinds of incomprehensible ways. I'm here to tell you they are the dog. They are the better three-dimensional picture of the dog, whereas the asset value is simply a two-dimensional snapshot which gives you much less information. People often talk about how, these growth in derivatives, 2020, 2021, people were actively saying, it can't last. This is just a blip. People are getting excited about the leverage they can get in options. What people miss, and I was very actively arguing for at the time, is options are like a technology. It's a superior way to express any piece of information or any knowledge. Accordingly, I've seen them grow in volume and interest over my 26 years now. And that's not about to end. The options market is essentially swallowing the equity and bond and all asset markets because it's a superior way to bet on information on a risk-adjusted basis. So once you understand, you have to start there. You have to really look at the world a bit differently. And once you understand that, any effect that happens in any part of the distribution to any asset or any positioning, even though it's not linear, has to, by definition, equate to an underlying effect in the asset itself, directionally, but also in the volatility distribution has knock-on effects as well. And so at the end of the day, you have to start with that perspective to truly understand how options are driving price changes in the underlying, but also how the underlying can then have effects on the other parts of the market as well. They're all integrally connected. Like I said, as somebody who held all the different parts of the distribution and the pricing, I had always a non-two-dimensional view on outcomes. It was really a view on probability outcomes and what paths were more likely, how the removal of certain paths and certain information could then ultimately affect the probability distributions as well. I gave you this example off camera before, but you have to understand if you have two assets, right, at the end of the day, and you didn't know, two stocks, let's say, and you didn't know what they were, they came from the same industry, they were the same market cap, same exact price, you would look at those two and say they're the same asset. Mm-hmm. But then if you peeled back the option chain and looked, one might be incredibly right distributed with a massively fat left tail, and the other one could be left distributed with a massive right tail, completely different risks, completely different dynamics. You'd have a much better idea of the risks and returns and outcomes that are associated with each asset. You'd realize they're not the same assets at all. And I think that's a good way to kind of visualize what I'm trying to talk about here. Yeah.
And in terms of market structure, this is something that we talked about just before we started as well, is like the general retail definition of market structure and their perception is technical based, like trending markets, higher highs, higher lows, and so on. But when we discuss that, from my understanding, is market structure really looking at the actual structure of how the market is moving and actually operating?
Yeah, so technicals, and the reasons they work, other than the second order effect, which is people watching technicals, again, themselves somehow affecting distributions. But the real core driver of why the major adages, the things going from seasonality to momentum to looking at Bollinger Bands, understanding how those things work, are primarily a function of structural effects that exist, macro flows that are not tied to anything other than the positioning in the market, calendar effects that are tied to expirations, end of the month effects that are tied to rebalancing and releveraging effects, and again, the positioning effects of options writ large. So people are essentially sitting on the other side of a door with technical analysis, trying to listen to what's happening, trying to from a distance understand what trends and rhythms they're hearing to try and predict what might be happening on the other side of the door. Whereas if you really understand what's happening, you have a keyhole and understand how positioning is affecting things. You can actually see what's driving a lot of those technical factors. That's the true market structure. Technical analysis is a sense of trying to sense what those things are that you don't really truly understand. So I think technical analysis is still useful if you understand what's actually happening through that keyhole, because you may not see everything that's happening, right? You still have a keyhole, you can't see what's out of frame, all kinds of things are happening, and understanding trends and why they happen and relating those to what you're seeing then can help you project and predict. So I'm not saying technical analysis is useless, but on its own, you can often make very false assumptions because you don't have a clear understanding of the drivers and structural realities that are driving that technical trend or breakdown or different things. So.
Where do you think a retail trader should start to learn more about actual market structure and actually what's going on behind that door?
So it's a new technology, right? And much like a new technology, when I talk about options, not that new, but new in the sense that it's becoming more readily available. It's affected by network effects, right? A new technology maybe exists for a long time before it gets adopted more widely. When I started in the business in '98, everything was written on a card in the pits. We had only quarterly expirations, 4 expirations a year. The options were on approximately, we had a 25 point in the S&P when the S&P was trading, about 400, right? So, you're dealing with like almost 1% gaps, no single list options. The multipliers on them were 250. Now you have 150, 10, 1.1, right? You have every day to expiration. You have every strike, everything. We used to trade in eighths. Now we trade in pennies, right? Or fractions of pennies. So those network effects of more structure have also been paired with education, access. You said you were talking to Tasty Trade recently. Entities like them educating, providing access. People like ourselves sitting on here educating, right? So where do you start? There's an incredible richness of information and education out there. I'd say we're tip of the spear because we were fortunately, in the depths of those markets and understand these things maybe better than many others. So we feel free to follow us and listen to what we have to teach. But there's a lot of literature out there, a lot more education. But similar to myself, sometimes learning isn't just read in a book. Sometimes you have to get in there, watch, understand, listen, and participate. And like I said, there's more ability, more liquidity out there to do those things than ever.
One thing that I found interesting from watching some of the recent interviews that you've done is prediction. I know is a big thing that a lot of people are interested in, and hearing your thoughts. And I know that you've set out sort of your prediction for the next year to 2 years in some of these interviews. Mm-hmm. But where does the sort of confidence and the mindset come from in terms of being able to make those predictions on a regular basis? As you said, you've already been doing it for the last 3-4 years publicly. Where does that come from? Is it from the mathematical equations and those distributions that you talk about, and then removing certain information based on certain outcomes no longer being in play, if that makes sense?
Yeah, I think it's actually, I don't want to say easy, but it's a lot easier to draw distributions, to get close to a broad set of probabilities and draw a distribution. Statistically, it's done in lots of different places in the world, right? Given a large number of outcomes, people can predict distributions based on understanding the physics, if you will, the actual supply, the demand, the pressures on the system. You can draw very reliable distributions. Predicting a single outcome is with infinite accuracy is impossible. That said, I have great confidence in our ability, understanding how markets work, to predict distributions. And so once you know the distributions better than other people, you can lay those out with some clarity. And people Sometimes those probability distributions that you lay out are not a 1%, which people might think based on a log normal outcome, but maybe 30, 40%. And then given X, Y, given Y, Z, F, right? Once you start to have these two paths out of maybe 1,000 paths, you can more reliably put a couple things out there that are incredibly valuable. Now, again, people focus on that January 13th prediction because it's two-dimensional, because it's so specific. And again, we've done that again and again, is highlight really high probabilities and then hit the high probability bets. But understand the real value is understanding the paths. Because again, you don't have to play in two dimensions. You don't have to go pick the gap-filled day. You can go bet in the options markets on multiple different paths and outcomes right now. I can go pick the 2, 3, 4 most likely paths on a distribution for the next 3 months, and particularly the ones that are priced quite differently maybe than are priced in the market, and then have laid out not a long bet or a short bet or a long vol bet or a short vol bet, but a series of distributional path bets that are incredibly low risk, high probability, great bets. And if you can do that again and again and again in the marketplace, that's an incredibly profitable way to trade. So I think the right way on a risk-adjusted basis to become long-term profitable, successful, is to remove yourself from just betting two-dimensional and trying to pin single outcomes in the market, but really start thinking again in probabilities and distribution.
In terms of probabilities, it's easy to look at, well, I say it's easy. What a majority of retail audience is looking at is just statistics based on their strategy, meaning they're a lot of the time technical based, maybe some macro in there to a small degree, but the majority have just got the statistics based on their strategy and how that edge plays out. How important do you think it is for people to go beyond that? And that's really what you've been highlighting, is that's thinking more two-dimensional. How do you think people can make that transition to thinking differently, thinking more three-dimensional?
Let's take a break for a minute there, guys, because I want to tell you about our sponsor, TradeZeller. TradeZeller is the #1 trading tool for all traders. It doesn't matter whether you're a crypto trader, a futures trader, or a Forex trader, whatever trader you are, all you do is connect your trading platform directly with TradeZeller. It automates and makes your trading journaling so easy. If you want to be a profitable trader, you need Trading Edge, and that is exactly what TradeZeller does. It allows you to identify edge, maintain your edge, and optimize your edge by automating your trade journaling, in-depth analytics, back testing, bar replay, and so much more. Now, WOR gets you 20% off your yearly subscription with TradeZeller. So use WOR for 20% off your yearly subscription, or Riz10 for 10% off your monthly subscription. The link is in the description below. Let's take a break for a minute there, guys, because I want to let you know about one of our sponsors. Alpha Futures is offering the best one-step evaluations in the industry. They have the largest end-of-day based drawdowns in the entire industry, with up to 90% profit split and lightning fast payout speeds, and offering advanced and standard accounts to fit your needs. Alpha Futures is truly offering the most elite plans for the lowest total cost to entry in the industry. You can start as low as $79. And thanks to the podcast, using code RIZ, R-I-Z, you can get 20% off any of those challenges. Go to the link in the description below, and let's get back to the episode.
Yeah, I mean, it's hard if you are not familiar with statistics, right? I mean, if you're not familiar with what a distribution is or what probabilities are, it's harder. So I think everybody's got to step back first of all and get that. Doesn't mean you have to be a statistical savant. You don't have to know, you don't have to be a statistician, right? But the reality is our brains, it becomes intuitive once you learn, because our brains work in probabilities. You reached out to me and you were like, hey, do you want to come on this podcast? My brain probably did some very quick probabilities of, well, he's not going to be here that long. Will we be able to do it some other time? How much time do I have? Is it worth my time? What's important to me, how does this mean, and it drew some set of, optimal outcome for myself to make me decide on expected value of yes or no. We all make decisions day in, day out, managing, preferences and probability outcomes. When you fall, when you walk before you fall, you're judging in real time. Your mind is judging whether you should put your arm out to protect your head, or if that's more dangerous for your arm than it is for your head. We do these things naturally. That's how our minds work. And in a sense, it's a series of ones and zeros. But those ones and zeros are nodes on that distribution, right? Much like an option. So I know this is blowing some people's minds out there, but this is a way of thinking and living and managing our lives and coming actually more in tune with what we naturally do. And I think it's an incredible education outside of markets that everybody should have. But I think the more you know that and you look through the world and markets through those lenses, the more success you'll have.
Taking that same mindset, for yourself personally, what's the time horizon looking like in terms of your positions? Are you primarily just long-term and thinking more long-term and sort of participating long-term, or is it a mixture, or is it more short-term?
It's a mixture. Different things matter over different horizons. So when we draw a distribution, it's not, you can draw a one-day distribution, you can draw a 1 hour distribution, you can draw a 1 week, 1 month, 1 quarter, 1 year, a decade distribution. And we really try and do all those things to the best of our ability. Those distributions are constantly evolving and changing based on information and changing on change and what we know to be true. But obviously, easier to predict one day than it is 10 years. In some ways, actually, I guess, right? In terms of, I guess I shouldn't say that. In some ways, a 10-year total outcome might be easier than a day, but very different information that drives those. Famous Benjamin Graham quote, in the short term, the markets are a voting machine, and in the long term, markets are a weighing machine. And what Benjamin Graham meant by that is in the short term, it's a function of supply and demand. People come to market, much like they did in the Agora and Greek and Roman times, and they have it's a function of how many buyers are in that market in that day, or sellers. It's not a matter of what that mule might be worth per se, right? But over the long run, with more liquidity, with more information, with markets that the value that mule trades for will be more in line with its pure value in terms of what people can use that mule for. So the weighing machine is essentially the outcomes and the true valuation, right? We talked about the tech bubble, right? Over short period of times, even sometimes years, valuations can be completely out of line with true value, right? As a function of liquidity and mismatch of supply and demand. But over the long term, things come into line with some type of value that's fundamental, if you will. The question is, what's long term? What's short term? Fundamental value itself changes over time. But to your point, we manage distributions in different ways over different periods, and we do predict, try and predict to our best of our ability based on the information we have, all of those. And all of them, as you might imagine, that 10-year outcome does affect the 1-year outcome, right? Those fundamentals do matter in a year, much like the flows really matter for a year. Those 10-year outcomes probably don't matter that much for one day, but they still have some effect. I think the biggest problem in media and broadly is everybody attributes 1 day, 1 week, 1 month, 1 year outcomes to that 10-year reality, to valuation. And so few understand the structural flows that go on a day-to-day basis that have almost nothing to do with that 10-year outcome. So We do both. We make trades on an hourly basis based on morning and opening flows, closing flows, how things are happening. We make bets on a daily basis based on, like I mentioned, option structure, expiration cycles, positioning outside of options markets, sentiment, liquidity rebalancing based on end of month flows, but also in the context of events, Federal Reserve meetings, unemployment meetings, presidential elections, all kinds of different things that have very short-term but also long-term effects. So I think the beauty of investing and trading and doing all these things holistically, like we try and do now, is we try and integrate all the macro information, but really in the context of probabilities for the long term, in the context of macro information and news that may come out, and how that affects short-term outcomes, and then try and integrate them all, mathematically and otherwise, in larger models.
Would it be possible, the January 13th as an example, regardless of the accuracy of the prediction, could we maybe talk about what the actual thesis and the distribution thought process was towards getting towards that date?
Yeah, sure, absolutely. I'm happy to walk through it. So November 29th, when the question was posed, in my mind, several things were clear in terms of probability distribution. One, that we sat there post-Thanksgiving and pre-Christmas and end of the year, that markets were up 20% plus, that we had in front of us the biggest annual options expiration for indexes every year, and you could argue the biggest options expiration ever in history because they're always going up.
The beauty of
not to mention the quarterlies have become, particularly the end of the year, become even more important.
What we try to do now is we try.
Why is that the biggest expiration?
All the macro,
the December expiration, by the way, which sits in the middle, the third Friday
for the long term, in the context of
every
macro
month, but the quarterly
flows
was I think December 20th.
Information.
Why was that the most important ever? Because structured product issuance has gone from 2 years ago $500 billion globally to $1 trillion per year.
And how
that issuance is bigger than it's ever been, and those are tied to a December OPEX. I also understood
mathematically
based on pricing and looking at option skew in the marketplace, how high the skew was in those expirations, how big the positioning was in those expirations,
as an example.
And so you took that information together. And what was obvious to us is there's massive structural flows,
maybe talk about,
which, by the way, we've been talking about since October. We had talked about the event and the election and how that outcome was also going to lead to this big spike up. So
towards getting towards that date,
we're very out in front of and have talked about. So we knew that also people were aware of this and were out in front of this. We knew based on positioning and underlying assets that positioning and underlying assets was
November
very
29th,
long, and sentiment based on many indicators were also overstretched. Yet we knew these flows were bigger than
when the question was posed,
than the importance of that during this period, and would likely lead to continued up
in my mind,
but with compressing volatility. So, before I made that call, we were very in October very prescient in saying that the market would get a nice spike, that volatility would compress throughout November and December, that you would have a lot slower move in markets because it was once that big spike happened. So again, distributions, understanding what the pressures are. So once you understand that November 29th, that there's all of these massive flows coming in, that people are very, very long and historically long speculatively, you see that this market will continue to glide higher until it hits a point which we thought, back in October, which would probably start a little bit later. So something closer to early January to mid-January, But we knew that before January 13th that decline would come. Well, knew is a strong word. That we knew that the probabilities were very high at that point they would come. So January 13th, being the Monday of OPEX, was a time after those releveraging effects from the end of the year were off the table. The DEES OPEX effects, supportive flows were off the table. That the January expiration, biggest flows from that Friday into Monday, would be coming off the table. And January, again, is the biggest expiration for single list options. And that all of these massive flows had one by one come off the table. And the one thing that would be left was very long positioning in the market without supportive flows to support it. And now, would that happen? Would that decline begin in late December because the flows from DEES OPEX were already off the table and all that was left was the releveraging? Would it happen after Jan 2nd, after those initial releveraging effects, and start January 3rd? We laid out different scenarios than where it would start. But the gap would most likely be filled on that Monday as a function of that. And there were many different paths that could happen. The more we talked about it publicly, because there are a lot of institutions that follow us and that are also trying to now track these things and understand what we're talking about. We in mid-December were very vocal and went out and said, look, the top will likely not happen in January, but we're probably going to top here going into the Wednesday or Thursday of
we talked about
expiration
and the election and how
and so it was also called out on the Fed meeting day and the day before that Fed meeting was the likely beginning. So we actually called that, more important than the Jan 13, we called the top in the market and the rollover, and also the stair-step nature of it, given that the flows were still there supporting. And then we also, obviously, so the point is that there's much more information there than just the Jan 13th, and if you follow and you listen to what we're saying, there's many trading opportunities that much far beyond than just that Jan 13th call.
During this period,
But that's how that date came about. And again, some people think it's a lucky guess. It's
well, no time machines.
Yeah, no time machine. At least not that I can yet talk about.
But is one part of that, or a huge part of that as well, like the knock-on effect of prior, what some may call predictions, but prior information that you then, led you to a particular distribution that then takes place, and then for that next one, so for the January 13th one, something would have happened before that to reinforce that one.
Yeah, it's a constantly evolving. The part that is increasingly difficult, but that we definitely model as well, are two things. One, people increasingly aware of these effects, and knowledge is vol dampening, we say, right? Like the more that people understand them, the more efficient markets become. Those flows are immutable, to be clear. Those flows are still there, but there is a counterbalancing set of flows on people, and that's part of why things have been a little bit earlier. We actually called initially for a September decline that came in August, on that big August decline after a big slow summer. A lot of that was, again, people aware out in front of it, and then when things actually, there's a catalyst, like there was in the Japan, the yen carry trade, that can then break things a little bit earlier. You have a different set of interactions. That said, the market structure is the market structure, and understanding the different path that then comes out of that is a function of that other positioning. This was the December reality that happened, as opposed to early January. That little bit, was also similarly understanding market structure, but also understanding that people are positioned in a way that now you have to account for in your probability distribution. So that, and increasingly, the more people listen to me and what we're doing. Seeing the efficacy and importance of it, I have to be very cognizant about what I'm saying when now in predictions. So there's also, it's crazy to think that we're having direct effects on market outcomes and structures, but at this point, obviously, given the accuracy of what we're doing, we are. So we're redrawing probability distributions based on what I say, which means I have to be careful about what I say, or when I say it, at least remodel a distribution accordingly. And so it's complicated.
When you say flows, could we just break that down for the audience?
Yeah, flows are just simply supply and demand, buyers and sellers of underlying, for predicting that. For predicting volatility, it's buyers and sellers of vol contracts or things tied to vol compression. There are flows in different vectors of the market, but I think for the most part, people are thinking asset, right? Underlying asset. And so when I'm saying flows, I'm talking about the buying or selling. And I guess, if you want to measure outcome to market, it's a pretty straightforward equation. How much liquidity is there in the marketplace? How much incremental buying versus selling needs to happen for the market to move X or Y, right? And then measuring what you know in terms of mutable supply, buying or selling of that asset in the context of that. Now, to be clear, we don't know all the flows. If we did, we would not be predicting distribution. We'd be predicting every day to the day, every time. I didn't say we have the door open and we're watching everything happening or that we're in that room. We're looking through a keyhole. But if you have 30 to, I would say 20 to 50% of the flows, and you know what those are, and I say 20 to 50 because on some days it's 20% of the flows, and on some days it's 50% of the flows. You may not have the whole story, but the beautiful thing is if you know 50% of what's happening, at the end of the day, that gives you a lot of information based on what's happening to price about what's happening to the other 50% of flows, right? And so the beauty here is we may know only 20, 50% of the flows, but we've learned a lot and we're constantly learning a ton about what's happening to the other things we don't know, even though we don't necessarily know what those flows are, right? We can model what we don't know as a factor and as flows as a function of what we do. So when I say flows, I'm talking about structurally not just the things that we know, the things that I mentioned, options flows, which we could dig into a little bit more, like the gamma, the vana, the charm flows, or the rebalancing, releveraging flows that are not option-centric. But what I can also look at is, what are these flows that exist that I don't even know what they are, the supply and demand, and what can I discern mathematically about those based on what I do know. And that's where technical analysis or structural trends and looking at those, framing out a framework to understand those in the context of what we know provide value as well.
What are your thoughts in terms of the average retail trader out there? Would they be able to have access to such information, or is that something more for your sort of positioning?
There are varying degrees. It's not like 1 or 0. Either you have it or you don't. You can understand trends in those flows, which is kind of a step beyond technical analysis, based on what tends to happen to the flows. You may not have transparency into the actual positioning, but there are trends in that positioning. On big quarterly expirations, for example, as I mentioned, you tend to have big positioning and bigger effect from Vana and Charm and Gamma effects. End of the year tends to be bigger, and those positions tend to be long put, short call for customers, short put, long call for dealers. And the rehedging effects tend to be generally predictable given those trends. So you can use some of this without actually fully knowing what positioning is or understanding exactly where things are. So there's a value in understanding that these things exist and they tend to have certain types of positioning under certain scenarios. But the next level is to then try and gather information and get more basic assumptions based on where it might be relative to normal. Is this a lighter positioning time, a heavier, or maybe there's no flows coming this time based on a very anomalous type of structure. The thing is you have to be, have some humility when you're doing that because you're focusing on trends and that trend may be wrong this time based on not having more detail. So to do it the best possible, you want to have as much information as possible, and not just as much information, but as much understanding as possible how to take that information and equate it to outcome. But there are varying degrees of education and knowledge and ability to use these frameworks without having all of the information.
Yeah. In terms of one key theme across this tour so far has been edge, the topic of edge. And I would love to ask you, like, what would your definition of edge be for you?
Yeah, I mean, edge is knowledge. It's having a understanding of something better than the rest of the market. That would be my first definition of edge. But I think a second corollary to that is being able to take that knowledge and then in a very precise way benefit from that knowledge to capture profit. You need both. You need the knowledge and then the ability to structure trades to capture that knowledge well. I think there are lots of people who are really good at isolating information and extracting value from markets. And there are people who are very good at understanding markets, having information and knowledge and extrapolating that. I think it tends to be quite rare to have people who do both really well. I do think options and a deep understanding of options and using them is an incredible tool to isolate information and capture edge. So I encourage people to really dive in and understand how to use options and what different positioning means. But I also encourage people to dive into understanding market structure and the flows and the knowledge of truly how markets work at their core. Because then if you can do both, you can really make an incredible amount of money and really capture an increasing amount of edge, as you said. Yeah.
What is the source of, whether it's passion for the markets, what is the sort of driving force for you to continue to do what you do? Because if it was money, no doubt, you probably could have stopped it a very long time ago, no doubt.
Yeah.
What is that drive?
Let's take a break for a minute there, guys, because I want to tell you about one of our sponsors, Alpha Capital. Now, without our sponsors, it's not possible for us to host such incredible podcasts around the world and get the level of guests that we are getting. So again, thanks to Alpha Capital for sponsoring the podcast. Now, Alpha Capital is one of the best prop firms in the industry. So far, this year alone, they have done over $50 million in payouts, which is absolutely incredible. They have the very best infrastructure in place for longevity, from an in-house broker so they can offer the very best trading conditions and platforms that all traders love to use. They're still able to offer services to the US as well, so the US traders can still trade with them on particular platforms. They have institutional experience, so they know how to manage a prop firm correctly and have such an incredible team on hand. On top of which, they have both a pro and swing plan. So depending on your style and strategy, you can choose which one is best for you. Now you can use and get the highest discount available at anywhere using RIZ25. So that's RIZ25 for 25% off all challenges. The link's in the description below. So let's get back to the episode.
Why do we do anything, right? We live a very short, it really is a split second in the grand picture of the world and the universe. And, quite honestly, it's having some effect. It's the same reason I educate and I do all this. It's having some real impact on the distribution of outcomes for the world, for lack of a better term. It's not about fame or fortune at the end of the day. We don't leave with either of those things, but we can, my knowledge is built on the shoulders of all kinds of other people who have left a legacy. We all live in a world, it's not just knowledge, but we live in a world where we depend on, we plug our outlets into, the wall and we take everything for granted. But all of that knowledge, all of that development, all those things that we stand on the shoulder of giants, and to get to be one of those people who, affects the world around us is what an honor, what a privilege. So that's the real reason.
Definitely. No, I love that. Yeah, I think legacy is a concept that's almost lost in this generation, I think, in terms of trying to have that impact in whichever way it is. It doesn't matter the industry. So I absolutely love hearing that. And in terms of the deeper options flows that you mentioned, should we go into those now?
Yeah, absolutely. So I mentioned there'd probably be a couple of second-order Greeks here. You know, a conversation with me would probably not be complete without at least referencing, you know, gamma, vana, charm, right? I want to make sure people don't get lost in the math or, you know, in the Greeks, right? But the reality is to understand the flows that come off of options markets and, you know, this three-dimensional surface of outcomes and positioning that are not linear, that are not two-dimensional, you really have to think about effects of other things other than just buying and selling of the underlying asset. You have to think about the effects of time. Again, the third dimension that we're talking about when we say three dimensions is time, right? And you also have to think about the effects of the distribution. Again, outcomes are not linear outcomes. It's probabilistic. So these realities of the, you know, call it the volatility surface or the distribution of outcomes, lead to these Greeks, okay, and these effects. What do I mean? Let's take one. Let's take charm. It is, you know, the measure of change in supply and demand on the underlying market, the delta, right, based on change in time, based on 1 day forward. So if there is positioning in the marketplace, which there always is on this distribution, let's say we're looking at the S&P 500, and you move time forward, that positioning in the marketplace changes based on the change of time. A 2-day option becomes a 1-day option, right? So as you move that distribution forward, that expected value of that distribution changes, right? And the positioning in the market changes and needs to be rebalanced. And you have to understand that the dealers, or when I say the dealers, I mean anybody, the whole world that is warehousing the net risk of the marketplace. Somebody has to warehouse all of this trading that's happening. All of that warehouse risk has to change, it changes its risk. And so whether you're a bank or a market maker, your goal in warehousing this risk is to extract an edge. And in order to do that, you need to lock down your risk and take your risk deck down to zero. That change in time leads to a buyback or a selling of deltas in the S&P 500. And it has to do it that day. And by the way, it doesn't happen you know, every minute of the day equally, right? Because we have an overnight session, markets aren't always open, right? People come and rebalance their books end of day, beginning of day. Particularly banks, entities are subject to regulatory requirements that are end of day, beginning of day. These things are market structure. It is not a continuous, right, distribution. It's disjointed with certain acts and certain incentives tied to regulatory reporting, end of month, beginning of month, like we're saying, options expirations and contracts. And so as time moves forward, these deltas change, but they change based on different intervals and different effects. And so charm is simply, as a Greek, the per 1 day change and the underlying delta of your position. But when I talk about, I'm talking about the changing of the warehouse risk of dealers, and that flow, to get back to flow, is a demand or supply on the market that can be measured, and that can be measured relative to liquidity and other supply and demand in the marketplace, both on an hourly basis, a daily basis, a weekly, monthly, quarterly, annual basis. So that's the charm. Vana is very similar. It's measuring the change in implied volatility. So per percent change in implied volatility, the volatility expectations of the market, per percent change in that, it's the amount of supply and demand. And those two things, the reason I often talk about Vana and charm together is they're integrally related. Because as time passes and nothing happens, implied volatility comes down. Also, based on market structure, there's a roll down. So as time passes, the whole curve rolls down. and that has vol effects. So Vaughn and Charm have to be looked at together. You can look at time effects, but you have to look at time effects as a function of vol effects as well. And vol effects are not only tied to that roll down in the market structure, but they're also tied to, if nothing happens over this time, over some period of time, vol declines at a certain type of trajectory, which then feeds back to these delta effects. So these are the day-to-day ones that very few people talk about, Vaughn and Charm, that I think are so important for prediction because they are structural flows that happen reliably day after day at certain intervals. They're higher, stronger, bigger over different periods with bigger positioning. And those are so valuable for prediction, way more than anybody talks about. What gets the focus tends to be gamma as it relates to options because it's sexier. It's a function of it's more convex. As markets move, it's the derivative of delta. So per change in underlying move, it's the change in the delta. So again, if there's positioning in the marketplace, and we know what that positioning is, if we get a certain percent move, the amount of flows that need to come out to rebalance for those moves, either reinforcing if it's short gamma or dampening if the market is warehousing long gamma, are incredibly important effects too. Now you can see how those interact too now, right? Because the vol compresses if vol is well supplied. And gamma effects are compressing, right? So market goes up, it's going to be met with sellers. Market goes down, it's going to be met by buyers because there's the warehousing of risk is long vol. That then is going to reflexively lead to vol compression over time, which is then going to lead to a supportive set of flows in a world that's short put, long call in general, which then reinforces vol dampening, which then reinforces more long gamma. And you can see how it's important to look at all these things together and how the flows are interacting. So when we're looking at flows and using those for predictive, particularly short-term distributional modeling, we're really looking at all these effects, but it's tied to understanding what the positioning in the marketplace is and how the warehousing of risk is affecting those directional flows in the underlying.
Processing all of that information, is that something you're doing individually? Is that something that you have technology for? Is that something you're doing as a team?
Yeah, obviously, we have these things called computers that do math a lot better than even I do here. We use technology to the best of our ability to model these distributions with as much predictability as we can. Now, I think to say it's all quantitative with no qualitative inputs would be dishonest and not true. The reality is that certain information and certain effects cannot be modeled. We can look at what we know for positioning and what we model in terms of certain aspects, but how the inputs of information and particularly when we're looking at the macro pieces and the news and other things that are less easily measurable need almost like a human input to gauge and put those in. But we are, even with those, we are putting our own kind of quantitative measure qualitatively into a quantitative model.
Love that. I did, in preparation for our interview, reach out to some of my friends to see if they had any sort of input in terms of questions of things. And there was actually one who stood out and said, I've been following Jem for so long.
Yeah.
And I'd love to, if it's okay, I'd love to go through some of these.
Of course, I love this.
What is a myth or thought most by people out there about options and or vol, so volatility, that you would like to dispel?
Oh, wow, there's so many. But no, good question. I think one of the biggest is that, I kind of referenced this, but I want to be direct, that vol is not an asset class. People think as volatility, actually even endowments and fund of funds were like, for some time, they're starting to change a little bit. We're allocating to vol as an asset class. Again, vol or options are, as I mentioned before, the distribution that underlies all asset classes. They are a tool, right, as we mentioned, to position more precisely. I guess I mentioned the tail wagging the dog again. That big idea that options are, in a sense, the underlying. They're a clear three-dimensional picture of the true asset itself. So I think those are the biggest things. The VIX as a representation of vol would be another big one. Like VIX is a representation of one kind of vol. It's a representation of floating vol. But I think to say that is somehow a fear index is a completely incorrect thing. The fact that seeing the VIX as some type of a hedge to equity markets is also an incorrect way to use it or think about it. It is not a measure of supply and demand in the vol markets, which in theory would be what a fear index is. If people are raising their view of what the risks are in the marketplace and buying more vol or options, that is a good fear index, and we can measure that, by the way, and that's very valuable for us. That's something that I encourage people to look at, which is fixed rate vol. It's actually looking at the volatility surface and understanding that rich data volatility surface in each product, how that's moving, and its full picture, and not trying to summarize all of this in one floating term that is itself subject to kind of skew and other factors in the market. So people say the VIX is broken. It's not broken. It's doing what it was always intended to do. People's understanding of what the VIX is broken. And so that would be another myth I would really kind of focus on.
Here's one as well. If any of these have been answered already, by the way, you don't have to do it again.
No, it's fine. Please, yeah.
But in the past, you've nailed many moves from a vol perspective. With this year being an inaugural year and coming off making fresh all-time highs not too long ago, how do you see this year playing out, and any key drivers to look out for?
So part of the reason that, really since February of last year, we were, again, for many years now, we've been very accurate in prediction, but really since February last year, we pretty much called every single major move and vol environment over the course of, I would say, 10 months. I think people can back that up and take a look. It's all there to see and, public. But the reason we were able to do that is, it's easier to do when you have a Federal Reserve and a administration that's consistent. You know what their incentives are. You know how they're going to react broadly to different outcomes. It makes the prediction easier because those are the things that we otherwise have a very hard time predicting. You can look at incentives and try and predict those things, but when those are more reliable, prediction for markets is more reliable. So the problem as you get to a new administration, particularly at one that is a vast departure from where you were, and itself, we don't have a lot of, even though again, Donald Trump and this administration, obviously we have some history to look at. It is, in our view, a very different administration this time around, the second time around, with very different players and a very different set of incentives. Just as an example, I mean, the last time around, 2016, 2020, Russia had yet to invade Ukraine. Yeah. Russia itself had yet to join China in a joint communique in opposition to Western influence. These are massive things. Trump's relationship with Putin in 2016, 2020 was very strong, for lack of a better term. Since then, we have had a very obviously adversarial relationship with not just Putin, obviously, given what's happened, but with Xi as well. Last time around, Trump was very strong against China. I think you can say that with tariffs, but also not just in rhetoric, but in actual actions. This time, how is he going to react? How is this administration going to act towards China in the context of still what seems to be a very healthy working relationship with the Russian government? These are big questions that are unknown and lead to a lot of volatility to certain asset classes and the broader structural prediction. The flows are the flows, but these bigger picture things matter as well. How is Donald Trump going to interact with the Federal Reserve? Powell himself is going to no longer be heading the Fed come next January. Well, at least that's what's likely based on what we understand. But how will he influence, and how will his Treasury and dissent influence, right, the Federal Reserve going forward? So all this uncertainty really makes the paths that we're now predicting. We now have multiple paths. We know what the flows are going to do, but the reaction to those makes a single prediction harder. That doesn't mean, by the way, having multiple paths is still very valuable, as we mentioned, that there's not a lot of value. But I think if you're looking for more, what's the next January 13th call, I'm happy to lay out multiple, but they may seem to people as us saying up or down. Well, again, remember, we're not predicting up or down. We're predicting paths that are highly probable relative to thousands of paths, millions of paths, honestly. And so we're happy and willing to do that. And we've been talking about that, much like we have for the last 4 years. But people who are kind of new to hop in the boat and look at things more linearly need to appreciate that things will become clearer and have more certainty and more path. Maybe not as much as the last administration in general, but the more we know, and currently we're gaining every day dramatically more insight and information about what's probable or likely. As related to that, let's dive into some of that prediction. We were out about a month ago, starting to hammer the table on that China, the path where Chinese mean reversion to U.S. and global equities, which is at a historic width, U.S. assets versus global assets in general, but particularly China, are at a dramatic width. And we have been very adamant that there's a much higher probability. We're getting more information to that direction as well recently, but that Trump, who everybody has been thinking is going to be very tough on China, much like a Nixon, it took somebody like Nixon to go open up China. We believe that Trump, counterintuitively, is likely to be much more cooperative with China and have a bit of a détente, if you will, with that, and that should open up some inflation, lower some inflationary pressures in the medium to longer term if he's successful, but also can really create a massive push in Chinese equities, which is a very convex and mispriced path. And again, no need to buy Chinese stocks. I'm not saying they're going up. I'm saying the probabilities which people were pricing at 5-10% just a month or so ago now, which they're now pricing at 15-20 as they continue to rally here, especially in the last week, as we're getting a lot of the news that there seems to be some interest in working with China, could very well come up to our probability of 40% or so, that there's a real attempt to do that, which should drive dramatic performance of what's otherwise a very convex trade. If you can go from a 5% probability to 40%, that's a huge trade with convex outcomes. So that was one thing we've talked about a month ago, which again it seems to be again coming in line with our probabilities and what we've said. But there's all kinds of prediction, right? That we're looking at when we look at prediction, not just the direction of the S&P 500, but the projection of constituents relative to the index. What kind of rotation are we seeing? What areas of the market are going to outperform? What's happening in the bond market? What's the likely outcomes there? And we have a whole set of predictions that we've been putting out. I'll give you a few more outside of China, just broad market action. You have to understand that the market now, which has run 50% in 2 years, is priced on a valuation relative to interest rates at historic highs. We talked earlier about my experience doing the tech bubble. That's the type of bubble we're talking about. Maybe not an outright valuations. The PE is significantly lower, but you have to understand 10-year yields are at a place and are going to a place which are driving a relative to interest rates, which is always what's critical, a historic valuation. Those valuations don't matter in the short term, but they do. I've kind of given this metaphor before. It's kind of like a plane. The trajectory of that plane doesn't matter how far off the ground it is, but it's the liquidity, it's the fuel that's driving it. But how far off the ground you are does really matter when that liquidity starts to but all that matters is how far off the ground you are. And so we know our elevation. We know we've been climbing dramatically for 2 years. And we also know that liquidity. The engines are running a bit low. And that's what that 10-year yield is doing. The inflationary structures are tying the Fed's hands a bit, at least in theory, because they have a mandate to control and manage inflation, which is growing. The question is, despite all that, is the Federal Reserve, with a Trump administration, despite that, likely to lean into the Fed and push still very hot economic policy? If we think those are the incentives, and that's the likely what's about to happen, the engines are about to get a bit more of a fuel, and we know that there's a lot of short positioning in the market given rational understanding of valuation and realities, and we're about to see a liquidity burst on a monetary perspective. We're about to see a potential détente with China, which is also stimulative. If we're about to see massive stimulation in the face of what has a lot of speculative short positioning, particularly low vol on the upside in these markets and understanding market structure, one obvious path is a right tail event similar to 2000, right? I wouldn't say it's going to be a multi-year, but we're already at 2 years in, 50%. And could we see a blow off top? I think that's a much higher probability than the market's pricing. I do think that this doesn't end well, and that would exacerbate structural inflation, which is a whole other issue we've talked about, not on this pod, but populism, protectionism, all the things that have driven that structural inflation, which is generational, by the way, and it's not going away against structural things we know. In the face of that, if we see a liquidity burst, that won't end well. That will, we could push off a bigger decline, but you're going to exacerbate inflation. And the 10-year in that situation will likely go from 5 or 4.75 this year to 6.25. 6.25 10-year in the face of a screaming equity market, increased liquidity. Again, we already mentioned how markets themselves create liquidity. Imagine now the Federal Reserve creates liquidity. We make some type of deal with China. You have protectionism still as part of that with other entities driving inflation, populism and fiscal policy driving more inflation. Now with a market that rallies another 10% here and creates another $10 trillion of liquidity, things can get incredibly hot and incredibly convex one way and then the other. And there's market structure in the terms of vol will increase into that, which will remove liquidity from the system, which will exacerbate volatility. You'll have more potential energy in the sense that the market will then be 10, 15% higher into what a valuation gap that needs to be filled long term. That then will exacerbate and create a different set of paths going forward. So that is definitely one of the big things we've been thinking about, talking about. We are actively watching what is Trump doing with the Federal Reserve? What is he doing with China? How are those going to play out? And measuring incentives and probabilities tied to that, because that is interacting with everything else in the structure we know. The other big path, and by the way, in that situation, I think we get to 66 to 6,700. Put a number 6666 out there, which is just like the perfect, little spot for things to kind of go weird, because technically and all kinds of other reasons, there's a confluence of things connecting there. It's also provocative. But also the other big path is we don't get that liquidity, which again, there are clues that we will, but if the 10-year continues to go from 4.75 here to on these now expectations of potentially, we're gonna run here in the market and they're gonna provide liquidity, we're gonna have a deal with China. If the 10-year now runs to 5.5 quickly, and then they don't provide the liquidity that's expected because they feel like they can't, or they wait and see, and the Powells and academics in that space say, listen, we have a mandate of inflation, we cannot, they push back against Trump, or for whatever reason he doesn't stimulate early. And there isn't a deal with China for any number of reasons, or even as much of an attempt to. And I think in that situation, I think there's another major path, which is I think we see mid-year a beginning of a structural decline in markets. Again, I want to emphasize that the one thing that's least understood by market participants, and everybody should understand as markets, is the reflexive nature of markets. There's a reason markets themselves lead recessions. People think it's, and this is wrong, that markets are smart, that they think 6 months ahead. They know 6 months ahead, so they're predictive because participants are wise. No, it's actually the fact that liquidity, the majority of liquidity, even more than the Federal Reserve, is created by the market itself. Again, $100 trillion in equities globally, give or take. Never mind all the things that are tied to global equities. A 20% decline in markets removes $20 trillion of collateral and liquidity out of the market. This market is such that if you remove that liquidity in the market, it'll be too late at that point for the Federal Reserve to push against it. The amount of effect to counteract that it would be dramatic, and they're likely to not be aggressive enough. I mean, in an initial 10-15% decline. And so I think under that scenario, especially given the size of volatility positioning and the potential, convexity in the marketplace, given how much positioning in the nonlinear parts of the market there are, would likely, in our view, in the back half of this year into early next year, lead to a 30 to 40% decline in markets. And then that would be, again, at first 6 months of the year, be choppy, people trying to short it, not working, options vol decaying, calendars expanding, but eventually would likely lead to a sell-off that started at a very counterintuitive time, tied to some counterintuitive catalyst that we're not even sure what it is yet, but likely tied to geopolitics or some type of governmental outcome. And again, the perfect time for that to happen would be in Q4 when liquidity is worse, Q3, Q4, and then exacerbated by some of these structured products that are sit in December, where the risk is the biggest. Now no longer fall dampening and supportive through these Von and Charms, but now exacerbating through gamma effects and all the positioning in that December and early January effects. So would be most focused counterintuitively in this very, what people think is a very supportive December, January of this coming year, but likely turns out to be a very convex and dangerous window. So two very kind of specific outcomes.
Yeah.
To somebody who's just looking at up down, they seem almost like you're betting.
Yeah.
You're
I think
betting
what's
in two
important
ways.
that you highlighted very early on into our conversation from the start, but also the question is, there's multiple. It's like a multiverse, right? It's like there's a spider's web, and what you're doing is really nailing it down based on information to only a few things that are probable, and then based on that, dependent on information that then becomes available to you, then really gets focused down to one or two, and then down to one eventually, when that information and all more information from the markets comes through.
Yeah, there are things we know that are not going to change. Right, those are structural flows, how they interact. Now, those structural flows those positioning can have different effects. Gamma effects, Von and Charm effects, based on these other things happening. But we know that those exist, and to varying degrees. Once you have the equation, there are things we don't know. You have to fill in those other unknown variables. Yeah. And those unknown variables will change your path.
Yeah. We had another one here. This was they said, I have to ask this question, which is when it comes to skew on intraday positioning, when looking at 0 DTE, let's say we are trading at local highs, what is something we should be looking at for continuation or a reversion back to mean?
Specifically for 0 DTE. So 0 DTE has so little vega in it, so little vol. So the Vana effects are actually unreliable, harder to measure. So little time, so the charm is also, again, it all matters, but the gamma does really matter in those situations. And because it's almost like a 0 DT is almost like an island. Think of it like a GME type product. Like anything could happen in GameStop because you couldn't hedge GameStop with anything but GameStop, right? That's why the gamma effects there mattered so much. That's why you heard all about the gamma squeeze and everything that everybody's talking about. Because if you're in a corner of the market that is so on the edge of market structure, it's completely subject to its own liquidity. And so the thing about 0DT that people don't appreciate, and part of the reason it's, I think, quite explosive and dangerous to market structure, is because, and market makers say this candidly, is like they only hedge 0DTE with 0DTE. The exchanges come out and very vocally and say, look, there are all this data that shows that market makers, are net flat 0DTE. There's not a bunch of one-sided trading that's happening. But the reason is, there is a lot of one-sided trading happening. But the reason is, when it happens, the market makers have to get out within their own 0DTE to hedge out the risk, or at least parts of the distribution of 0DTE. And so because of that, it's this close loop. And when you have a closed loop, like I said, what happens if somebody hits the market with 10,000 0DTE, 2% out of the money puts? We've actually seen it happen, not 10,000, but and what you get is the market can't handle that, because all of the dealers have to hedge that all at the same time, and you get a cascade that pushes the market down to that strike. So there's this ability to manipulate and push market action through 0DTEs. So I guess my one response to that is that it's not always the case, because a lot of times that the size and scale of those types of trades and positioning don't exist. But if you want one piece of information that's incredibly valuable to predicting outcomes on a very short-term basis, if there are big trades that go down, those are going to not only have delta effects in terms of the hedging of it, but the convexity of that can be dominant and self-fulfilling. So I would be really, really watchful of trades in real time and volume in 0DTE. And if you're not watching that stuff and you're just playing it somehow technically, or you're exposing yourself to some dramatic, significant effects.
If someone who's less capitalized would like to trade vol like yourself, what is a way they could do so?
Well, if you're less capitalized, one of the first things, it's beautiful nowadays that you can play fractional options. You can size positions all the way down to the smallest of sizes. You used to not be able to do that. I think one of the keys is you have to be in the most capital efficient structure. You have to be portfolio margined. If you're trying to trade options with Reg T, like, you're gonna blow yourself up and you're at an automatic disadvantage. So I would strongly recommend against it. So I think to have a portfolio margin account nowadays is like 50K, 100K. I would be, if you can't do that, right, I would at least go under some umbrella that can do that for you. So again, I think if you're just forced to post dramatically more capital, you really put yourself in a tough spot, and it's going to be really difficult. That said, how do you take advantage of it? You understand statistics, understand probability, look at a distribution, map out your paths, understand based on that what the options are generally pricing. Come to understand how options pricing works. Doesn't mean you have to understand, how Black-Scholes came to be. It's your history. I mean, if you do, great, but it's not essential. It's really understanding probability and what options deltas mean in terms of probability, how they work and how they change in pricing. I think an education on options that understands how they are volatility, what implied volatility is, and what probabilities are, and then simply mapping that relative to what you think markets are going to do will allow you a really nice framework to profit over time. Just like anything, it takes experience and it takes practice, but you can start really small in a portfolio margin account and kind of start replicating.
With the rise of 0DTE volume, how do you think that affects things moving forward? Exacerbating moves or making the waters more muddy?
Yeah, I think that's a good question, actually. I think reflexively positioning does the exact opposite, or it provides the same impact on the market as what the instrument itself does. So 0DTE, in some good ways, or the movement of trading to 0DTE in some good ways will dampen volatility over periods longer than a day, because it will leave less positioning post that day that can implode and create a bigger structural problem. Think long-term capital management. There's the reason long-term was in long-term capital management. They were out in options a year, 2 years out. If you're in an option a year, 2 years out, and things start to go badly, and the value goes up and up, those are marked to market. You're not getting those back for a year or two, and you have to at some point come buy them back, and that creates a bigger structural problem. If you're in 0DTE, you bet today, it's gone tomorrow. All right. So in that way, it's good. So when people say, "Oh, these are going to blow up the system," now, that said, it is that point, as we mentioned, that's so far out on the distribution on the very 1 day left that the gamma effects are unhedgeable by anything else, and it's a closed loop. And so similar to a GME, which can just, at the edge of a distribution, just go, and there's, it's a closed circle. The same thing can happen in 0DTE. So it exacerbates 1 day crash risk. There's no doubt in my mind. It can within a day create a dramatic, volatility to the volatility, and that's that vol, I think, is definitely enhanced, increased by 0DTE in general.
What I'd love for us to finish on, really from yourself, because I know that you do, as you mentioned, loads of, especially now being reached out by almost everyone, I imagine. But this, I think, is a unique opportunity, more so for the retail side, for the retail audience. And I would love for you 2 points, really. One being, what would be your advice to them trying to enter this space, if they haven't already? But secondly, just your general advice to the retail traders out there who haven't experienced a bubble before and generally just navigating these very volatile, uncertain markets. What your advice for them would be, just from your experience and from having such a long-term career so far?
Yeah, there's so much wisdom to impart. I think risk management, that concept, is critical. So when you think about, what is a market maker? A market maker absorbs liquidity and tries to neutralize all risk from every vector and extract a yield or some type of return. In the option space, those vectors of risk are much more than just how long am I, how short am I, how much exposure to vol do I have per change in day, all the multidimensional aspects. And so I think thinking about risk management in a very multidimensional framework, I think is critical. I think managing kind of nonlinear risks and thinking about things in nonlinear ways, I think is critical. And again, I think if you learn to use options, you can not only manage risk, but position in ways that are very risk adjusted, very specific, and really will lower your max potential loss while giving you significant potential upside. So options, right, we've talked about it at length, are an incredible way to create incredible positive outcomes, but you have to understand and size and scale appropriately, and you have to really begin to think about them, again, in terms of laying out a path and trying to capitalize on that, the risk, of that path, isolating that path in the best possible way. So I think if you take that approach, which we've kind of referenced throughout this conversation, you'll really find over the long term, you'll lose a lot less on things that you're really not betting on. Again, if you're long an asset or short an asset, you're betting on all kinds of outcomes that you probably don't really care or know about, and you'll capitalize more on whatever edge you develop or whatever knowledge you may have, and over time, I think that you'll become a dramatically better trader.
Yeah. Jem, it's been an absolute pleasure and honor to host you today, and hopefully we'll get to catch up in the future as well.
Yeah, wonderful meeting you.
Yeah, post 2025 predictions potentially. But yeah, absolutely wonderful to meet you. Well, everyone, make sure you drop a comment below with your biggest takeaway from this episode. I know there was so much, probably the most in-depth episode we've ever had. So make sure you rewatch it a bunch of times and make as many notes as possible so you really ingrain all the lessons that Jem has dropped for us today. Now, links for Jem will be in the description below, so make sure you check those out, as well as Kai Wealth, which is Wealth Advisory. So check that out if that is suited towards you. As I said, huge thank you to Trade Zeller for helping make this US tour possible. You know, the most in-depth analytical tool, as well as automated journaling, as well as backtesting, as well as so much more. The links for them are in the description below also. Now, make sure you hit subscribe. Other episodes are on screen. Be ready for the rest of the episodes from the tour. And until next time, everyone, take care.
You have to love trading first. Yeah. It is so intensive. It plays with every emotion that you've ever had. It's not for the faint of heart. And anyone that tries to tell you it's easy is a liar, a complete liar. And unfortunately, there's a couple of really big people in the space that are like, I only need 20 minutes a day, then I go play golf. I'm like,
Welcome everyone back to the Words of Wisdom podcast. We are back once again, still here in Dubai, and we are joined by someone who I'm very excited to have on the podcast. He is the traveling trader, aka Z, and he has traveled all the way. Was it from LA?
From LA, yeah.
Incredible, absolutely incredible. Very humbled and honored to have you with us, and that's not a short flight.
Yeah, it's not a short flight, man. I just want to say thank you so much for having me on. Thank you for inviting me on. The things that you're doing in the space are incredible, dude. Like, I've been tracking your progress, seeing the numbers, the way that you're able to garner interest of the masses and direct them towards our boring world of trading. It's just amazing. And I think a couple of months ago when I spoke to you on Twitter, I said you're our Joe Rogan, and I really mean it, dude. So congrats.
I appreciate it, man. I appreciate it. Joe Rogan's like the top tier, you know, top tier, and I appreciate it. And we're just always learning, always growing. That's what it's all about, you know. And I love it. Let's just go straight into it. You know, traveling trader. I love that because you know, the majority of people, that's kind of their dream. That's their vision when they get into trading. It's the freedom, and then they do want that travel lifestyle, travel trading lifestyle. So what does that look like for you? Because I've actually seen your YouTube channel, very big YouTube channel. I love it. It's so extensive. But there's a lot of travel. Like you look at different videos, you're in different places.
For sure. Yeah. I mean, that's always been a dream of mine since I was young. I've always loved traveling. That's, you know, being chained to a desk was definitely